and welcome once again to Economy and World. Today I want to talk about an analysis that demands your full attention. What is happening in Argentina at the beginning of 2026 is not just a passing news story. It is the most radical, ambitious, and controversial economic and social experiment of our contemporary era. I want you to imagine for a moment that you walk into a butcher shop in downtown Buenos Aires. You pick up a piece of meat marked at a price of 800 pesos. While you are waiting in line to pay, you notice an employee quietly walk over and replace the label with one that says 950, and not even 10 minutes have gone by. That feeling of helplessness, that moment of watching the value of your work evaporate right in front of your eyes. This was the everyday reality for millions of Argentines at the end of 2023. Inflation was not just a number on a chart. It was a wildfire that devoured a monthly salary in a matter of weeks. Annual inflation of 201%, with monthly peaks exceeding 25%, a currency melting faster than ice in the desert. But now the picture changes with the arrival of Javier Milei, a man with disheveled hair and an incendiary style who did not promise an easy road. He promised a painful adjustment through what he called the chainsaw plan. Today, international markets celebrate what they call the Argentine miracle. Sovereign bonds are rising, and the International Monetary Fund is giving a standing ovation. But is all of this really true? We know that miracles in economics usually come with a very dark fine print that no one wants to read out loud. We are going to dissect that fine print. We are going to talk about the technical engineering behind the blender. We are going to analyze the trap of the strong peso. And we are going to find out whether this fiscal success is a foundation of solid granite or simply a house of cards held up by the strategic support of the Trump administration in Washington. To understand the magnitude of the chainsaw, we first need to understand the depth of the institutional rot that Milei inherited when he arrived at the Casa Rosada. Argentina was not always a patient in intensive care. Let us briefly go back in time. At the beginning of the 20th century, it was one of the 10 richest nations on Earth. Buenos Aires was known as the Paris of South America, a destination for European immigrants, with per capita income levels higher than those of much of Europe. However, a century of populism and chronic fiscal deficits destroyed that architecture of prosperity. Imagine the scale of the disaster. Over the last 123 years, Argentina has run a fiscal deficit in 113 of them. The country became accustomed to systematically spending money it did not produce. The central bank ceased to be an independent monetary institution and became the petty cash box of a political class that refused to cut its own privileges. Every new banknote coming out of the printing machine created no wealth. It only destroyed the value of ordinary people's savings. When Milei took office in December 2023, the consolidated fiscal deficit stood at 4.6% of GDP. International reserves had evaporated. They were negative by several billion dollars. The country was technically bankrupt, and hyperinflation was knocking at the door with devastating force. The response was not a gradual reform. Because, as the president himself said in his inauguration speech, there is no time for gradualism when the building is already on fire. Milei's diagnosis was not technical. It was ideological. He saw the problem not as a macroeconomic imbalance that could be adjusted, but as a fundamental institutional decay. The central bank had become a tool for fiscal financing. Public spending had expanded far beyond productive levels, and regulatory restrictions prevented markets from clearing, creating chronic shortages and black markets. This is where the technical concept you must understand comes in, the blender strategy. Most people think the adjustment was carried out simply by cutting contracts and closing ministries, but the reality is more sophisticated and much more cruel. The blender consists of keeping the government's nominal spending virtually frozen, while runaway inflation automatically reduces its real value. Think about it this way. If the state must pay a pension of 100,000 pesos and inflation is running at 20% per month, but the state continues to pay the same fixed 100,000 pesos, then in terms of purchasing power, that obligation has been drastically reduced. The government wipes out its obligations without having to announce an official cut in the state bulletin. It was an adjustment through inflationary erosion. This mechanism made it possible to move from a deep deficit to a primary surplus of 1.4% of GDP in 2025. It was the first annual fiscal surplus since 2006. However, these were not cyclical changes driven by rising revenues during a recovery. This was a structural fiscal adjustment achieved through a sustained restriction of spending. The administration used executive decrees to freeze nominal budget allocations while allowing the prices of public services such as energy, water, and transportation to adjust to market levels. The prices of these services rose exponentially between December 2023 and March 2024. The overall price level almost doubled in that short period. The devaluation, together with the liberalization of controlled prices and a sharp monetary contraction, hit at the same time. Government nominal spending, held constant, now represented a dramatically lower level of real spending. Pensions absorbed 38% of the initial spending cut. Nominal pension payments were frozen or increased only very modestly, while inflation eroded the purchasing power of retirees. The average pension fell 25% in real terms. Teachers, public sector employees, and government contractors also faced nominal freezes or increases far below inflation, suffering real income losses of between 25 and 35%. At the same time, the government suspended public infrastructure investment, froze capital spending, and postponed transfers to provincial governments. In some cases, it suspended obligations altogether, or paid them using peso-denominated bonds of uncertain value on the secondary market. The arithmetic worked for the accounting books. The deficit disappeared. But the social consequences became increasingly visible as 2024 progressed. Universities saw their budgets cut by 30% in real terms. Professors' salaries fell by similar amounts. Building maintenance was postponed, and funding for scientific research simply evaporated. Faculty received frozen wages while inflation ravaged purchasing power, triggering widespread strikes throughout 2024 and 2025. Retirees, many of whom were already living on pensions barely above the poverty line, saw their incomes compressed even further. This led to organized protests and constant street blockades. In March 2025, police repression resulted in serious injuries, including a photographer who was struck in the head by a tear gas canister. The provision of health services deteriorated markedly. Hospitals faced extreme budget constraints, pharmaceutical coverage was restricted, and medical research was curtailed. This is the distributive reality we must analyze. Wealthier Argentines who could afford private education, private healthcare, and private transportation were less affected by this adjustment. But those who depended on public provision were crushed under the weight of austerity. There is a deep irony here. A libertarian president elected to dismantle the power of the state ended up using the power of the state to force the poorest to bear the cost of stabilization. To complement this fiscal consolidation, the administration implemented a three-phase monetary strategy designed to establish credibility and reduce inflation through an appreciation of the national currency. Phase 1 began in December 2023 with a brutal 50% devaluation. The official exchange rate moved from 400 pesos per dollar to 800 pesos. This eliminated much of the currency overvaluation that had accumulated under the previous administration. It made Argentine exports more competitive, but at the same time pushed up domestic prices of imported essentials such as fuel and food. Then came the crawling peg. The exchange rate would depreciate at a predetermined rate of 2% per month. The logic behind this was that in a highly dollarized economy, where residents price goods in dollars, the exchange rate acts as the crucial anchor for inflation expectations. By committing to a devaluation rate below the prevailing inflation rate, the administration sought to engineer a real appreciation of the currency. The peso gained value in real terms despite nominal depreciation, thereby pulling inflation down toward the pace of currency devaluation. The government pursued this through import compression, a recession-driven contraction in domestic demand, and a recovery in agricultural exports after the end of a historic drought. In June 2024, Phase 2 introduced a nominal freeze on the money supply. The government signaled that there would be no further monetary expansion, firmly anchoring expectations. But this is where the trap closed on the real economy. The 2% monthly crawling peg, combined with inflation rates that exceeded that pace of depreciation, generated an increasingly aggressive real appreciation of the exchange rate. By February 2025, the central bank cut the rate of devaluation to 1% per month. This created a fundamental tension. The exchange rate anchor reduced inflation rapidly, but that very reduction generated a peso appreciation that undermined export competitiveness and created incentives for capital flight. Investors began to anticipate an eventual large devaluation to correct this imbalance. You must see the trap. The very policies that stabilized inflation made the currency unsustainably strong. These tensions forced the transition to Phase 3 in April 2025. The system moved from a crawling peg to a dirty float, a state-managed floating exchange rate regime. The official rate would fluctuate within a band set between 1,000 pesos per dollar at the floor and 1,400 pesos per dollar at the ceiling. The band itself would expand each month by 1% at both limits. The central bank would intervene within this band, buying dollars when the peso appreciated toward the floor and injecting pesos to prevent excessive strength, and selling dollars when the peso depreciated toward the ceiling to absorb domestic currency and prevent weakness. Crucially, these interventions would not be sterilized. When the central bank bought dollars, the supply of pesos increased. When it sold dollars, the supply of pesos contracted. This approach automatically linked exchange rate policy to monetary policy. However, by the end of 2025, the peso came under renewed pressure. Investor confidence weakened following corruption allegations involving the president's sister. Political complications emerged after the September 2025 elections in Buenos Aires, where the Peronist opposition outperformed Milei's party. Serious doubts arose about the long-term sustainability of the fiscal adjustment. The peso depreciated toward the upper limit of the band, where it has remained ever since. The government has carried out substantial interventions to prevent a further depreciation, using the central bank's limited reserves and purchasing dollar-denominated assets in secondary markets. These interventions represent a return to active exchange rate management, despite the theoretical commitment to floating rates. The dirty float turned out to be very dirty in practice. The Milei administration achieved an undeniable and substantial reduction in inflation. Monthly consumer inflation fell from 25.5% in December 2023 to around 1.9% by mid-2024, reaching lows of 1.5% in May 2025, the lowest monthly inflation rates in many years. Year-on-year inflation dropped from 201% at the end of 2023 to about 43% by mid-2025, a reduction of 168 percentage points in just 18 months. Wholesale prices even recorded deflation in May 2025, falling by 0.3%, the first decline of this kind in 17 years. These achievements represented genuine progress in the fight against one of the most severe inflation crises in the world. But here is what other channels do not tell you. Understanding the mechanisms behind this decline requires distinguishing between temporary factors and lasting ones. The reduction in inflation operated largely through a one-off price-level shock. The exchange rate adjustment and price liberalization allowed previously suppressed prices to jump upward. But the subsequent disinflation worked through different channels. The real appreciation of the peso reduced inflation in tradable goods. The recession-driven contraction in aggregate demand reduced inflation in non-tradable goods. And the nominal freeze in wage growth reduced cost pressures. Private sector wage growth lagged inflation by wide margins throughout the period. Nominal wage increases were constrained by high unemployment. This means that declines in real wages functioned as a powerful disinflationary mechanism. Lower purchasing power limited demand for goods and services, reducing pressure on prices. The key question is whether these mechanisms are permanent or vulnerable to a violent reversal. Now, let us set aside the big numbers for a moment and talk about a real victory that admits no nuance: the complete elimination of rent controls in Argentina. This is a fundamental case study for understanding libertarian thinking. The previous law, imposed in 2020, severely restricted price setting and mandated 3-year contracts indexed by the state. The result was a catastrophe. Property owners withdrew their units from the market, preferring to leave them vacant or move them into the informal dollar market. Between 2020 and the end of 2023, the supply of rental listings in Buenos Aires fell by a staggering 53%. Real prices rose because the few landlords who remained inflated the initial rent out of fear of future inflation. When Milei repealed these controls through his mega decree in December 2023, the market response was almost immediate. Rental listings rose from 5,500 in December to more than 15,300 by June 2024. We are talking about a 180% increase in just 6 months. In the Buenos Aires metropolitan area, total supply increased by 212%. Tenants finally had options to compare and negotiate. Most striking of all, despite removing price caps, real rents fell by 27% in the first 7 months. This is empirical proof that when you remove an artificial constraint and supply explodes, prices move toward equilibrium and consumers benefit. However, this microeconomic victory took place in the context of a deep recession. Employment revealed tensions that cannot be ignored. The unemployment rate rose from 4% in early 2024 to 7.9% in 2025. Almost 250,000 additional people lost their jobs in 1 year. The construction sector was hit the hardest. The complete halt in public works and the collapse of private investment eliminated 65,000 formal jobs, a contraction of 15%. Manufacturing lost a further 25,000 jobs due to falling consumption and a peso that had become too strong against imports. Job quality also suffered a severe blow. Formal employment declined relative to informal work. By early 2025, only 46% of Argentine workers had a registered job with Social Security coverage, the lowest level since 2007. Displaced workers ended up in the informal economy with lower incomes and no benefits. Real wages in both sectors fell between 25 and 35% during the initial adjustment period. The government restricted wage increases in order to anchor inflation expectations. This means that the success of disinflation was financed directly through the loss of workers' purchasing power. This brings us to the poverty paradox. After Milei's inauguration, poverty jumped from 41% to a peak of 53% in the first half of 2024. More than half of the country fell below the poverty line. The government justified this as a necessary clearing process before recovery. Fortunately, by the end of 2024, the figure had fallen to 38%. Extreme poverty also declined significantly thanks to lower food inflation and the end of the agricultural drought. But we must be cautious. These reductions represent a partial recovery from the abyss, not a return to prosperity. Approximately 11 million Argentines are still living in poverty today. Meanwhile, the elite with savings in dollars experienced the adjustment as an opportunity to acquire assets at fire sale prices. This distributive inequality is a structural feature that the chainsaw has not resolved. As for exchange rate policy, Milei's promise of full dollarization has run up against reality. The central bank does not have sufficient reserves, and dollarizing today would imply a risk of a massive run. For this reason, the administration maintains capital controls despite its libertarian rhetoric. The chainsaw president cannot cut the currency controls because he fears the building will catch fire again. The geopolitical factor is the great lung of this plan. Alignment with the Trump administration has been total. This facilitated a $20 billion IMF program, the second largest in history. In May 2024, Janet Yellen declared Argentina a systemic ally. This backing enabled a key currency swap that has helped defend the peso. But this dependence on Washington is a double-edged sword. If U.S. priorities change, or if Trump's support weakens, the Milei plan would lose its financial oxygen overnight. What can we conclude? Milei has achieved undeniable macroeconomic victories: zero deficit, inflation crushed from 201% to 43%, and reserves being rebuilt. But the social cost is the Achilles heel. Argentina has traded one crisis for another. Hyperinflation has been stopped, but the patient remains in critical condition and without anesthesia. The question is not whether the surgery was necessary, but whether the patient will survive the recovery. Milei's bet is that confidence will bring investment before social patience runs out, but history suggests that these plans often face violent political backlash when adjustment lasts too long. The macroeconomic scoreboard says partial success, the social scoreboard says urgency, and the political scoreboard says uncertainty. This is not just a national experiment. It is the global model for countries drowning in debt. If it works, it will become the new manual. If it fails, it will be the definitive warning about the limits of extreme austerity. That concludes our analysis. Thank you for listening, and do not forget to subscribe. Thank you very much.